Hello friends, season's greetings. Hope you had a great Diwali. Wish everyone a very happy new year. As the world seems to be witnessing upheavals, Indian equities are standing tall as an outlier. The month of October has seen a fair bit of volatility in the equity markets. However, the large cap Nifty is up 4.1% for the month as we speak. The NSE mid cap and small cap indices are up 1.4% and 3.4% respectively. India continues to outperform the MSCI Emerging Market Index in dollar terms. In terms of flows, data till 27th October shows that for the month, there were marginal net FII outflows. Cumulatively, FIIs have registered net outflows of almost $22.7 billion for the calendar year to date. Domestic institutional investors, on the other hand, were net buyers of Indian equities in October to the tune of $1.3 billion, taking the cumulative net buying to more than $33 billion CYTD. The dream run of inflows into mutual funds continued in September. Equity inflows rose to almost 149 billion rupees in September, which is a 3-month high. Flows have now been positive for 19 consecutive months. Systematic Investment Plan or SIP flows rose to 130 billion rupees in September, which is again an all-time high. On the global macro front, it does appear that higher interest rates and inflation are likely to be sticky in the developed world. With inflation in the US now being driven more by services, it is possible that the Fed would continue on their monetary policy tightening path. The key to watch out for would be the trajectory of US wage growth and the labor market. With higher interest rates globally and uncertainty on growth in developed geographies like the US and Europe, equity markets may remain volatile in the near term. Geopolitical tension remains the other key risk to monitor. India is clearly an outlier on economic growth. High-frequency economic indicators continue to track well, boosted by the festive season. The festive season data on cars, houses, credit card spends all show strong growth. Festivity has resumed after a 2-year gap. Other high-frequency economic indicators have tracked well as well, and this includes e-way bill, GST collections. In fact, bank credit growth has increased to 17.9% YOY, a 42-month high. While there have been some downgrades to India's GDP growth projections for FY23 by the consensus, overall Indian economic strength is commendable in the global context. September CPI inflation in India increased to 7.41%, led by rising food prices. However, the September WPI inflation fell sharply to 10.7% from 12.4% in August. Inflation in India is at present ahead of RBI's comfort zone. However, RBI expects that the average inflation will moderate to about 5.2% in FY24. Headline CPI inflation in Q1 of FY24 is projected at 5%, which is within RBI's comfort range of 4% plus minus 2%. Friends, the one macro factor that we must keep close watch on is the external sector and the current account deficit. RBI has stuck to their stated objective of not targeting a level of currency, but managing currency volatility. We expect that this stance would remain unchanged. With forex reserves now at about 9 months of imports and with oil prices and the current account deficit remaining elevated, we expect that the near-term depreciating bias of the INR versus the USD would likely continue. We are now in the midst of the Q2 FY23 quarterly earnings season. The earnings season comes on the backdrop of fairly strong demand as well as consumer sentiment, which has seen improvement going into the festive season. The earnings season so far has seen dispersion between sectors, but at a headline level, numbers are largely in line with consensus estimates. Domestic-facing sectors have fared better than those with global linkages. The quarterly financial performance shows that for the 22 Nifty companies that have reported numbers so far, net sales continues to grow at a robust pace of 26% YOY. However, higher input costs have impacted margins, resulting in a more moderate PAT growth of about 4% YOY. We expect margin trends to improve from H2 of FY23 onwards, notwithstanding a sharp increase in commodity costs. We believe that in the medium term, India continues to be in the midst of an earnings upcycle. Now turning to valuations, India's recent outperformance has resulted in the Nifty PE trading marginally above historical levels on an absolute basis, while on a relative basis, India's premium to emerging markets is at a historical high. Going ahead, friends, there are multiple global macro factors at play, and hence some degree of volatility is something that we would have to navigate. India growth appears to be stable and is a relative outlier, and therefore in the medium term, the outlook for Indian equity markets remains healthy, especially given the strength of domestic macro growth and the corporate earnings trajectory. We continue to believe that bottom-up stock picking will be the way to navigate this near-term volatility, focusing on high growth, high quality companies trading at reasonable valuations. At present, we believe that domestic facing sectors geared to domestic demand are better placed. The sectors that we are positive on remain banks, capital goods, manufacturing and automobiles. We would approach global sectors like pharma and IT on a more stock specific basis. As we look forward to the new year, we would advise investors to continue to follow a very disciplined approach to equity investments, depending on their investment goals and time horizon, while focusing on their asset allocation strategy. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.